Hi everyone, it's Jack back with another video, and today I'm going to be doing a video on Bed Bath & Beyond, stock that is really all over the place, had a really turbulent history as of recently, trying to decipher what exactly is going on with this company. I'm not really going to speak about the death of Gustavo Anal, the CFO, which is obviously a great tragedy. They've recently fired Mark Tritton, who is the CEO, who I thought was someone who would do a good job. He came over with rave reviews from Target, where he was the chief merchandising officer, did a very good job there, got the top job at Bed Bath & Beyond, and things just have not gone to plan. Now, of course, from a stock perspective, at various times, it might have looked like things were going to plan because the stock was massively up, and that is because this was essentially a meme stock, and probably still is, has 40% short interest, 40% of the float is short interest. Easily explains some of the crazy spikes with a lot of short squeezes. This is very much involved in the meme stock blow up in 2021. It's had various points where the stock was over $30 this year. Should it have been? Absolutely not, in my opinion. Right now, it's a $700 million company. We're at around $8 share price. That's still 100% above its 52-week low, with no real good news to speak of. Down 67% in just over a month. Really, a lot of money has been made, probably on the upticks and the downticks, but plenty of money has been lost over the long term. This is very much a struggling business. So I want to talk about the measures they've taken in the most recent investor update, look at the valuation, things like that, and decide whether this is a salvageable business from an investor point of view. So looking at the most recent numbers we have, they set some preliminary expectations in an interim update in Q2 on August 31st, and a look pretty grim. Approximate sales of 1.45 billion, comparable sales versus last year for approximately a 26% decline. Free cash flow going to decrease. The preliminary expectations for the whole fiscal year 2022 is a decline in sales of around 20%, which they believe is it is an improvement in the second half versus the first half. That's what they're predicting, but this is still pretty grim reading for any Bed Bath & Beyond shareholder or potential shareholder, and it's just not really when you want it to be. The capital expenditures are going to come down, and they're closing approximately 150 stores, which is just, perhaps it's needed because this is clearly a bloated business and they want to focus and readjust the business essentially. But seeing capex go down is basically because this is a very poorly capitalized business and they are struggling. Liquidity is a massive issue. So we'll talk about debt in a minute, but it's a $700 million company right now. Debt is around 3.3 billion. So you're looking at 4.5 times market cap. That is quite a serious amount for a company that's not free cash flow positive right now. So they've had to execute capital structure objectives essentially to enhance the liquidity. So previously they had around $500 million in liquidity. That's what they have in Q2. They believe going forward they've expanded some facilities to essentially give them an extra 500 million or thereabouts to about $1 billion in pro forma liquidity, which is definitely going to help. It strengthens their ability to spend basically and to service their debts. But this is still very, very dangerous territory. This is starting to look like a company that is going to go bankrupt if it can't right the ship soon and get itself consistently profitable. They believe they're going to see some sequential improvement in Q2 for free cash flow. But I'm worried for this business dramatically. I don't think this real focus on getting liquidity is a short-term survival objective, absolutely. But this is not good signs for any potential shareholders. So the first part of the plan is clearly increase liquidity to allow this business to survive, basically. The second half is cost optimizations. They need to drive profitability. They need to be consistently free cash flow positive. So they're right-sizing the cost structure and store fleet to drive savings, they believe, of approximately $250 million in financial year 2022. And they're also lowering the capex plan for this year by $150 million to now $250 versus 400 million originally. They're also closing approximately 150 of the lower producing Bed Bath & Beyond stores, which is already underway, and they're reducing workforce across corporate and supply chain by 20%. These are all absolutely necessary steps that had to happen to help a bloated business survive, basically. And while these are, of course, and no one likes to see large layoffs or store closures, for the wider business, this is ultimately going to be a good thing if they can survive and refocus. Their immediate actions are anticipated to impact Q2 with sequential improvement in free cash flow, as I mentioned earlier. They believe that focusing on remodeling and new store openings will resume later on, but right now they just need to focus on righting this ship, closing underproducing stores and getting to profitability and cash flow, so they don't need this expanded liquidity facility and they can fund themselves. But ultimately, these are very worrying steps. Closing a large amount of stores is not a good thing to see for a retailer. Looking at some balance sheet and profitability metrics, that cash to debt is a little out because these numbers are slightly skewed. They still have well over $3 billion in debt, which is extremely worrying for a company that is a $700 million market cap company right now with no profitability. The cash number is a little lower. It's actually a little higher. It's around $200 million in cash on the balance sheet as we saw in the previous slide in that update, because these are the Q1 results basically. So the cash debt is a little less severe than that, but it's still less than 0.1. You're looking at, well, it's double that would be 0.06, which is a very, very low cash debt ratio and of severe concern for a company that was profitable, never mind the company that is unprofitable right now, not free cash flow positive. This is a very, very serious situation in my opinion. They're not producing strong return on invested capital, so the money they're putting into the business is essentially going down. Very, very worrying times from a balance sheet perspective. This is a pretty putrid balance sheet, in my opinion, when you combine that with the free cash flows that are just not coming in. So while this business generates almost 30% gross margin, which is not terrible for retail, it's actually pretty good for this industry, or at the very least above average. It's not producing net margins and operating margins. Minus 6.4% operating margin, minus 12% net margin. It's a business that's losing money hand over fist, has a return on invested capital percentage of almost minus 16%, which is absolutely awful. It's only been profitable for 6 of the past 10 years, and I can't see that happening in the near future. So it's actually very hard to value a business like this. It's purely projection. So looking at these valuation metrics, there's nothing you can really look at here. While it looks objectively cheap on things like a price to sales basis, do you really want to buy this company, or could you even possibly value this company on a price to sales basis? It produces tons of revenue, but has a putrid balance sheet and is not looking to be profitable in the near future, at least in the short term, and could potentially go bankrupt. So on a valuation basis, I really don't know what to do with this company, because I don't think it's worth valuing. I don't think this is a stock that you could buy realistically for anything other than speculation. Right now, that is my belief, that if you're buying this stock, it's purely for essentially its meme stock value that it has. Big upswings and big downswings from short swings potentially. However, can this ship be righted? Very possibly. With the right owner-operator, this could be saved. Bed Bath & Beyond, I'm sure there's still some brand equity here. It still has a place in this world. But do I think it's going to ever get back to its highs in the short to medium term, say 5 years? Not really. I think this is likely going to hit its 52-week lows again soon. The short interest is not going to go away, because this seems like a relatively easy short at the minute. But I just cannot see this company getting to this 52-week high in the next few years. This is going to have to be a multi-year transformation to get this company to, say, a $5 billion market cap will be an incredible feat. And to be honest, in my opinion, to save this company from bankruptcy and shrinking even more dramatically would be an even more incredible feat. However, absolutely not impossible. And for those who are very, very patient, this could be a good investment. But for me, I just could not possibly endorse anyone buying this stock. But of course, that's just my opinion. You should form your own opinion, not listen to me, because I'm not a financial advisor. You should do your own research and due diligence. Let me know what you think of Bed Bath & Beyond the stock. Of course, a lot of people have a lot of opinions on this, because it's a bit of a meme stock. So I'd like to hear what you got to say in the comments below. Let me know what you think. Like and subscribe and enjoy the video. I'll see you again next time.